Hi guys, so let's explore the current account on the balance payments in a little bit more detail. Okay, so remember what we saw last time, that the current account calculates the trade in goods and services, that is the trade balance. These are our visibles and invisible products on the current account, together with net investment income. So that is investment income which is repatriated away and outbound from the UK, as well as investment income flows coming into the UK. So that is our income balance. Now, of course, this is made on investments overseas by the UK and its citizens. So this will include areas such as portfolio investments, as well as foreign direct investments, and likewise when it comes to investment incomes being taken out of the UK economy there. Okay, so let's just understand these terms in a little bit more detail. We encountered them last time, but let's just uncover this a little more. So a current account deficit is simply going to mean that the value of imports and investment outflows is greater than the actual value of exports and investment incomes or investment inflows into the country. Okay, so that's fairly straightforward to understand once you are clear on the definition for the current account there. Okay, now further to that, we can also therefore work out what the current account surplus position is likely to mean. And the current account, when it is in surplus, is going to mean that the value of exports and investment income inflows are greater than the actual imports and investment outflows within a given economy. Now, the surplus, of course, is a positive representation for a country's balance payments, and the deficit is a negative. Of course, the UK runs a persistent current account deficit, and that's something that you really need to understand the reasons behind. But there are good examples of countries that run persistent current account surpluses. Of course, we mentioned Germany last time. Another great example is, of course, China, a famed trading nation, where here you can quite clearly see that the value of their exports and investment income inflows are greater than imports and investment outflows. Okay, so yeah, that's the fundamentals here, but there's a number of key reasons as to why a country may actually run a current account deficit. So let's have a look at some of these potential causes. Certainly, the UK economy has been cited as being vulnerable to a number of these points that I've highlighted here. So firstly, it could be as a result of an overvalued exchange rate. Prior to the Brexit referendum, some people did argue, and some economists argued, that yes, the UK current account position was becoming unsustainable and was becoming quite a worry for the economy. And part of the reason they argued for that was the currency had actually become overvalued. Of course, the currency has subsequently depreciated. More recently, it's gained a bit of that value back. But nevertheless, having an overvalued currency, of course, means that you've got spiced. Strong pound, imports cheap, exports dear. Okay, so yeah, there's a key vulnerability where a country has an overvalued exchange rate. Further to that, if there is a high level of consumption or a high marginal propensity to consume within the economy, and the citizens within an economy want to go out and consume goods and don't undertake much saving, then yes, that's also likely to mean that they are going to be buying goods from abroad. Okay, yes, some goods will be UK made and manufactured, but a large quantity of those manufactured goods, of course, will come from abroad. Now, further to this, and this is slightly related as well, is that if you have an unbalanced economy, perhaps you don't have a big manufacturing sector, or perhaps you have a real focus on consumption, rather than investment or savings, perhaps, and too little savings are being carried out within the economy, then yes, this can also pose big problems, and certainly relates back to that point regarding consumption. So if you think about the makeup of the UK economy, the manufacturing sector and jobs within the manufacturing sector have certainly declined quite substantially since the 1980s there. Okay, there's also the possibility as well that a country's international competitiveness may be being eroded, and there's a number of reasons as to why this could happen. Investment is one of those potential reasons. So if there is an inadequate amount of investment taking place in perhaps research and development, then that's likely to mean that you won't be able to sell cutting edge products overseas or cutting edge services overseas, because you don't necessarily have that expertise, having not carried out sufficient research and development. So it's very important that economies do try to ensure that they are really investing in the long-term future and moving up the value chain when it comes to their export sector. Okay, there's another reason as well, and we can see that quite clearly here. So when the value of imports and investment income outflows is greater than the value of exports and investment income inflows. So what we also see within this here is the fact that if you don't own that many assets overseas, then you are not going to have lots and lots of income coming from those assets that you own overseas. So those investments overseas will not be bringing you lots and lots of income, and so therefore it can be about an inadequate amount of investment in overseas markets. Okay, so that can also contribute to your current account position. Now, on the flip side, of course, causes of a current account surplus, well, we've got the exact opposite here. It's often argued that Germany and China have an undervalued exchange rate. Certainly in Germany and China, the level of consumption is much lower than the UK, and their marginal propensity to save is far higher. Their economy has a bigger manufacturing sector, so we see almost the exact opposite in those scenarios where countries run those current account surpluses. Okay, right. I hope that's useful. Thanks, guys.